Your money is losing a silent battle right now, and most investors have no idea it's happening. In the next 60 seconds, I'm going to show you the exact number that proves the old investing playbook is dead, and the two-step fix you can implement this week. I'm breaking down a 50-page institutional research report so you don't have to. Here's what you're getting in the next 12 minutes. The one portfolio allocation that Wall Street is quietly moving toward. It's not 60-40 anymore. 3 free AI tools that give you hedge fund level research. I'll show you exactly which ones. And the single biggest mistake that will cost investors 30% of their portfolio value by 2027. Watch the video till the end, because I will reveal the 15% rule that protects you when markets crash. Let's start with why your money is bleeding value right now. Here's the number I promised, 2.6%. That's how much purchasing power you're losing annually if your money is sitting in a basic savings account. JP Morgan's latest forecast shows inflation cooling to 2.4 to 2.8% by late 2026. Notice I said cooling, not disappearing. This isn't temporary. It's the new permanent baseline. Why? 3 reasons your grandparents didn't have to deal with. Reason number 1, governments are spending more than ever. Fiscal budgets aren't shrinking, they're expanding. That money enters the economy and pushes prices up. Reason number 2, labor shortages aren't going away. Demographics don't reverse quickly. Fewer workers mean higher wages, which means higher prices. 3, global trade is fragmenting. The cheap imports that kept inflation low for 30 years, that era is over. This means every dollar you save loses value every single day. A $10,000 emergency fund becomes $9,740 in real purchasing power after 1 year. Do nothing, and in 5 years, it's worth $8,700. The interest rate trap. So you're thinking, I'll just put my money in bonds and collect interest, right? Not so fast. Central banks are cutting rates by about 50 to 75 basis points in 2026. That sounds good. But real rates, the actual return after subtracting inflation, are staying barely positive. Translation, your bond returns are getting eaten by inflation. And if you're carrying debt, mortgages, car loans, business financing, they're all staying expensive. You're stuck in the middle. Savings accounts lose to inflation. Bonds barely break even, and debt stays costly. This is the squeeze, and it's exactly why the old 60-40 portfolio doesn't work anymore. While your savings are bleeding value, something massive is happening that most people are missing. The $2 trillion shift happening right now. $2 trillion. That's how much is being invested in AI in 2026, according to Gartner. Not over 10 years. This year. But here's what matters to you. For the first time ever, you can access the same tools that hedge funds pay millions for, completely free. 3 tools you can download today. Let me get specific. These aren't theory. These are tools you can use tonight. Tool number 1, ChatGPT for stock research. 1 in 10 investors already use this. That number triples by year end. You can analyze earnings reports, compare competitors, and identify trends in minutes instead of hours. It's like having a junior analyst working for free. Tool number 2, FinChat or Magnify AI. These apps give you instant financial modeling. Type in a stock ticker, and you get multi-year projections, risk analysis, and valuation metrics. This used to require a Bloomberg terminal costing $25,000 per year. Tool number 3, PortfolioPilot. This one's powerful. You upload your portfolio, and it runs stress tests. What happens if inflation spikes to 4%? What if tech stocks drop 20%? What if interest rates jump? You're testing scenarios that professional risk managers run, except you're doing it on your phone, for free. The playing field just got leveled. The question is, are you using these tools, or are you competing against people who are? Now, let's talk about where to actually invest. Because knowing the tools is one thing. Knowing where to put your money is another. AI investment breaks into 3 layers, and each one is growing at different speeds. Layer 1, AI infrastructure. Growing 83% this year. Think of this as the foundation. Data centers, cloud platforms, cybersecurity for AI systems. This is the plumbing that makes everything else work. Companies like Microsoft, Amazon Web Services, and specialized chip makers. Layer 2, AI applications. Growing 57%. These are the programs doing actual work. Automating customer service, detecting fraud, optimizing supply chains. Every business needs these. This layer is massive and diversified. Layer 3, AI hardware. Growing 23%. The servers and processors built specifically for AI workloads. NVIDIA dominates here, but there are emerging players in specialized chips. Notice something? Infrastructure is growing fastest. That's always true in technological revolutions. The people selling shovels during a gold rush make more consistent money than the miners. If you're building a long-term portfolio, Layer 1 infrastructure is where you anchor your AI exposure. It's less sexy than buying the hot AI app company, but it's more reliable. Here's where it gets really interesting, and most investors completely miss this connection. AI and inflation aren't separate problems. They're interacting in a way that creates massive opportunity. On one side, you've got persistent inflation driving up costs for housing, energy, food, all the physical stuff. That's the problem we discussed. On the other side, AI is creating what economists call productivity deflation. When a company automates 40% of its operations, it can produce more output with less labor, less energy, less waste. Those savings are enormous. The number to remember, $4.6 trillion. That's the productivity value AI is adding to the global economy in 2026. To put that in perspective, that's enough to offset about half of all inflationary pressure from supply chain disruptions and energy costs. The new inflation hedge isn't gold, it's efficiency. This changes everything about how you protect your wealth from inflation. Old hedge, buy gold, buy real estate, buy commodities. New hedge, invest in companies that are aggressively implementing AI to cut costs and boost output. Here's a real example. India's financial sector is using AI for credit analysis and risk assessment. Result? Operational costs down 40%. That means these companies maintain profit margins even when wages and materials costs rise. Compare that to a competitor who doesn't automate. Same rising costs, no efficiency gains. Their margins get crushed. The AI-efficient company is the modern inflation hedge. When everything costs more, they're producing more for less. That's the advantage that compounds over years. This is where I show you the portfolio allocation that institutional investors are quietly moving toward. The 60-40 split is done. Bonds can't protect you when inflation is structural. You need something different. Here's the adaptive portfolio for 2026, 50% equities, 20% fixed income, 15% alternative assets, 15% cash, 50% equities, but not just any stocks. Focus on AI infrastructure players and companies with proven efficiency gains. Think Microsoft, companies in cloud computing, industrial automation leaders. These have pricing power and margin protection. 20% fixed income, drastically reduced from 40%. Only short-duration bonds and TIPS, Treasury inflation-protected securities. These adjust with inflation, unlike regular bonds, 15%. Alternative assets, real estate investment trusts, commodity exposure, private credit, the tangible stuff that benefits from inflation. 15% cash, high-yield savings, money market funds. This is your opportunity fund and your market crash insurance. This cash position isn't dead money, it's strategic power. Here's why. AI stocks are trading at historically high valuations right now. When the correction comes, and it will, most investors will be fully invested, watching their portfolios drop, unable to act. You'll have 15% sitting ready to deploy. When quality assets drop 20 to 30% because everyone's panic selling, you buy. This is how you turn volatility into wealth building. Quick note on income investing, because this is changing too. If you're retired or living off investments, you can't just buy dividend stocks and call it done anymore. Fixed dividends lose purchasing power at 2.6% per year. A $1,000 monthly dividend is worth $974 next year in real terms. The solution? Dynamic income sources that adjust with market conditions. Covered call ETFs. These collect premium income from selling options while still holding stocks. The income adjusts based on volatility. When markets swing, premiums increase. AI-optimized REIT funds. These use data to adjust property holdings based on rental trends and location demand. Your income fluctuates, but it adapts to keep pace with inflation. The goal is income that responds to economic conditions, not income that's fixed while costs rise. Let's talk about what can go wrong, because every opportunity has a dark side. Risk number 1, overvaluation. Many AI companies are priced for perfection. They're trading at 40, 50, even 60 times earnings based on growth that hasn't happened yet. There's a term for this: AI fatigue. It's when the actual earnings reports can't justify the stock prices. And when reality hits, these stocks drop hard. Your defense: know the difference between AI enablers and AI chasers. Enablers: companies providing essential infrastructure, chips, cloud services, data security. They have real revenue, real profits, proven business models. Chasers: companies that slapped AI on their marketing but haven't fundamentally changed their operations. These are the ones that crash when the hype fades. Stick with enablers, avoid chasers. It's that simple. Risk number 2, political uncertainty. 2026 has major elections across the US, Europe, and Asia. New governments mean new policies, potential impacts, new tariffs, stimulus spending, changes to tax policy. Any of these could trigger fresh inflation spikes or market volatility. Your hedge: geographic diversification. Don't concentrate everything in one country. Spread across multiple economies and currencies. When one region struggles, another may be thriving. Risk number 3, the herd mentality trap. This one's dangerous. Here's the problem. When millions of investors use similar AI tools, they all get similar signals at the same time. Everyone sees buy and rushes in. Everyone sees sell and panics out. This creates synchronized moves that amplify volatility. The crashes get sharper. The rallies get more extreme. Your defense: build in pause rules. When you feel the urge to make a big move, buying or selling, force yourself to wait 24 hours. Use that time to check if you're responding to real analysis or just following the crowd. AI can crunch numbers. It can't provide wisdom or patience. That's still your job. Alright, let's make this actionable. Here are 5 specific steps you can take this week, not someday, this week. Step 1. Run a portfolio audit. Pull up your current investments. Calculate what percentage is in stocks, bonds, cash, and alternatives. Compare it to the 50-20-15-15 allocation we discussed. Where are you overweight? Where are you underweight? Write it down. Step 2. Download one AI tool and test it. Pick ChatGPT, FinChat, or PortfolioPilot. Choose one stock you're curious about. Run it through the tool. See what analysis it provides. You don't have to invest based on it. Just get familiar with how these tools work. Step 3. Build your 15% cash buffer. If you're fully invested, this means gradually selling positions. Start with your lowest conviction holdings or your biggest winners that you've been meaning to take profits on. Move that money to a high-yield savings account. This is your opportunity fund. Step 4. Identify one AI infrastructure investment. Research one company in the AI enabler category. Not an AI chaser, a real infrastructure provider. Read their earnings report, understand their business model, add it to your watch list. Step 5. Set a quarterly review calendar. Pull out your phone right now. Set a recurring reminder for the last Friday of each quarter. That's when you rebalance, review, and adjust. Markets drift. Your carefully planned allocation will drift too if you don't actively maintain it. 5 steps, completely doable this week. Look, here's the reality. The investing game changed. Persistent inflation isn't going away. AI tools are democratizing access to institutional-level research. The old 60-40 portfolio doesn't protect you anymore. You can ignore these changes and hope your current strategy works out. Or you can adapt. The investors who thrive in 2026 aren't the ones with the highest IQ or the most money to start with. They're the ones who recognize when the rules change and adjust accordingly. Remember these numbers: 2.6% inflation eating your cash, $2 trillion flowing into AI infrastructure, 15% cash buffer protecting you during corrections. You now have the same information that institutional investors are using. The question is, what are you going to do with it? Here's what I want you to do right now. First, leave a comment telling me which of the 5 action steps you're implementing first. I read every single comment, and I'll respond to as many as I can. Second, if this breakdown gave you clarity on how to adjust your portfolio for 2026, hit that like button. It helps YouTube show this to other investors who need to see it. Third, subscribe to Simple Money Method if you want more deep dive analysis like this. We cut through the hype and give you actionable financial intelligence every single week. Thanks for watching. I'm here every week helping you build smarter money habits. See you in the next one.